So heading over to the pound, the pound US dollar. This one is a bit of a tricky one because I actually, spoke about this on my video that I did over the weekend. So this is a classic channel contraction. As you can see here, we've got a little channel here in the market. And normally, every single time, I mean, normally the markets do break out of this channel on the upward direction, and I spoke about this on my video 2 weeks ago, that you should wait for this break, which is gonna happen. And obviously, if you miss that trade, then yeah, now you have to just kind of try and focus on what the market is gonna do next. And with this type of contraction, this is very, very hard to trade, because the normal person will look at this and tell you definitely that this market should be going up. Because when a market breaks out of a contraction like this, out of a channel contraction, what usually happens, I think when I made my video, I gave you guys two different diagrams, and I said, if you don't understand what the market is going to do, so we have a particular contraction like this, where the market breaks out of the contraction, comes back to the previous structure, and then it rallies. And we also have a different type of contraction, very similar. The market breaks out, come back down, break the previous structure, and then goes in the other direction. Now if you can't look at these structures and know why the market behaves differently, I said you shouldn't be trading, because this is a classic example of understanding the language of the Forex market. Because this is like, I mean, obviously the major difference that you can see looking at this structure, if you don't already know, if you're in this live chat and you don't already know, the obvious difference is this point in the structure. That's the obvious difference. And what's different about this? The market breaking this structure when it comes out of the contraction, that creates a bullish structure, with this being the outside return. And if you know the rule of the bullish structure, the market cannot break the outside return, because once the market breaks the outside return, that is a signal that this market is about to change direction. Whereas in this case, we did not break the outside return. We did not break the previous structure, which is going to be the initial structure high. If you're looking at this as a bullish structure, this is the initial structure high. This move out of this contraction does not break the previous structure. So any move back down is only going to form a bigger part of the outside return. So that's why most of the times when you see structures like this, that the market breaks out of a contraction without breaking the initial structure high, the market will almost most likely go in that direction. Whereas looking at the structure like this, hi Samir Ali, I can see, guys, yeah, if you do have any questions, just put it in the live chat, and anything relating to trading, analysis, questions you may have. Obviously, I do live trading streaming on here, but I don't have any potential trade that I could be taking today. I mean, the only potential trade could be on the pound yen, and we're gonna look at that in a minute. Oh, amazing, amazing! We do have some Indian friends here in the UK. Yeah, so do you have any questions on trading? Anything that you want me to go over? Just put it on the live chat, guys. But as I was explaining, so the difference between these structures is very, very important, because if you don't know the difference in these structures, I say do not even trade. Like, just stay away from trading, guys, because this is one of the classic I call it language of the forex market. Technical analysis is language of the forex market, and if you don't understand structure, we're gonna look at some examples, and you're gonna see how the market behaves. 9 times out of 10, if the market forms a contracting channel and breaks out of the contracting channel without breaking the initial structure high, it's gonna come back to the previous structure and the market is gonna rally. Now, this is more like 50-50. If the market already breaks out of the contracting channel and goes above the initial structure high, then this move down should not go beyond this level here, because if it does, then it breaks the outside return. You know what a bullish structure is. You know the what's it called? You know the rule of a bullish structure. So if the market breaks out of this and comes back to the previous structure, breaking the previous structure completely invalidates the bullish structure, because that is a sign of communication. And when the market does that, effectively this become 1 to 3 as part of a trend. The market breaks the previous structure. Of course, 9 times out of 10, when the market breaks the structure, it doesn't just go in that direction. It will retrace. It always does. So you get the retracement, and then the market moves in that direction. And this is what we're seeing right now. If we look at the pound US dollar, I said this in my video over the weekend. We got the contraction. We got the impulse leg, right? Let's go up a little bit. So we got the impulse leg. We're getting the contraction. We got the break. And did the market break the initial structure high? Yeah, it did. So now, after breaking the initial structure high, you don't expect this market to come below this level. Now, if this market is to continue being bullish, which the market is, I mean, if you look at the market if you zoom in, you're gonna see that we're completely bullish. Now, this is how you, when as a trader, as a technical trader, as long as the market stays above this structure, because you have to remember, now you're looking at this as a bullish structure. I need to change that color a little bit because it's, now you're looking at this as a bullish structure. And when you look at this as a bullish structure, having this as your starting point, where's my, I'm just gonna abbreviate it, guys. I'm having this as your starting point. This is your initial structure high. I'm gonna answer your question in a minute, Samir. This as your outside return, pullback, retracement, whatever you want to call it. And this as your new structure high. And if you understand bullish structure, the bullish structure has 3 different rules that it must fulfill, right? 2 of the rules have to do with the outside return. So now we're in the process of creating another outside return. So this is an outside return. And this outside return has 2 rules that it must stick with for this market to continue being bullish. The first rule is the outside return of a bullish structure must come in and touch at least the 382 Fibonacci retracement. Now we can see the market has gone past the 382 Fibonacci retracement. So that rule has been fulfilled. The next one is the outside return of a bullish structure must stay above the starting point. In this case, the previous outside return, because this is going to become our starting point. So if this market, the market needs to stay somewhere in this zone, you would expect a retracement. So if you're a trader, if you were to go long in this market, like this is a perfect trader, you can go long in this market. Whoever is knows how to trade contraction and expansion. But I'm just trying to, tell you something, because one of the things, the most important thing about trading, guys, is the psychological part, the emotional part. And the only way you are able to control that, if you are alert, if you understand structure, if you understand where you shouldn't be, what trade you shouldn't be in. And this is very important, because once we get this structure, you can place a long trade here, you can buy this market. But the minute this market comes back down and break the previous outside return, the moment it breaks below this structure, you shouldn't be in that trade.